we're going to have a look at a summary of the T accounts and the entries when we have changes in partnerships. When you're doing your assessment, it's really important that you organise your T accounts nice and neatly, because there's quite a lot of information in those T accounts, isn't there? We've got different columns for all the partners and we have multiple entries. So if you're not very well organised, then it can become a bit messy and there's a chance you may get your answer wrong. Our top tip would be to have your goodwill all on the same line on your T account. So on the debit side, on the left side, you've got your goodwill, and on the same line you've got the goodwill on the credit side as well. So you'll be able to see that the total of the debits for goodwill is the same as the total for the credits for goodwill. Because when we balance off our account, there should be no carried forward amount for goodwill. The goodwill at the beginning of our change in partnership is this going to be the same as the goodwill after the change in the partnership. So let's start off by looking at an example. And in this example, we're going to focus on a partner joining the partnership. A and B are in partnership sharing profits in the same ratio as their capital contribution. C joins the partnership paying $10,000, including a contribution to goodwill, which is valued at $15,000. The new profit share ratio will be A to B to C is 2 to 2 to 1. So the new partner will be getting less profit compared with the existing partners. So we've got our T account here, and you can see that we've got columns for each of the partners, and we have their brought forward capital amounts. So this is capital, so you can see it's on the credit side. So the first thing we need to do is give our partners some of this goodwill. So the new partners coming along, and we've valued goodwill at $15,000. So we need to include that goodwill on the credit side and allocate it between the two partners in the same ratio as their profit share ratio. So we can see that we've got £25,000 of capital at the moment, and that's split between $10,000 and $15,000. So we can see that the profit share ratio is 40% for partner A and 60% for partner B. So we need to allocate the goodwill in the same ratio. So we've got the 15,000, so 40% of that would be 6,000 for partner A, and 60% would be 9,000 for partner B. So that's the goodwill that we've allocated to the two original partners, and then what we need to do is then share it between the partners, but including the new partner as well. It's still going to be a total of 15,000, but now we're going to use the new profit share ratio. So in this case, if we're sharing the 15,000 in the ratio of 2 to 2 to 1, that means we're going to have 6,000 for partner A, 6,000 for partner B, and 3,000 for partner C. So we can see for partner A, the goodwill on the debit side is the same as the goodwill for the credit side. So there's no overall effect on partner A. Whereas for partner B, we've got 6,000 on the debit side and 9,000 on the credit side. So there is going to be some effect here. And then we can see that partner C has 3,000. So what we need to do next then is balance off our accounts. So we've got a total of 16,000 for partner A, and it needs to be balanced. So we've got 16,000 on the debit side as well. So we can work out then what our carried forward balances are going to be. So partner A has a carried forward capital balance of 10,000. So that's the same as the brought forward figure. So partner C coming into the partnership has had no impact on partner A. Everything's the same. We started off with 10,000 brought forward, and we've got 10,000 carried forward. Okay, well, what about partner B? So partner B is, we've got a total of 24,000. Again, that needs to balance. We've got 24,000 on the other side. And so we can see here in this case, when we balance off our account, our balancing number, the carried forward balance, is going to be 18,000. So partner B's capital has increased. Yeah, we started off with 15,000 and then finished off with 18,000. So partner B's made some money out of the partner joining. Now what about partner C? Well, we know that partner C has also contributed some capital. They're paying in 10,000. So we need to include another entry here. So we're going to debit bank 10,000 and credit the capital account with 10,000. Yeah, we wouldn't be able to balance off the account without that. So there's our total of 10,000. And that needs to be on the debit side as well. So now when we balance off the account, we can see that the carried forward balance is going to be 7,000. So partner C has paid in 10,000 into the partnership account to become a partner, but the capital balance is only 7,000 because we can see that effectively partner C is paying partner B 3,000. Now, why is partner B getting this 3,000? Well, we can see that because of the change in the profit share ratio, before we had 40 and 60%, didn't we? But afterwards, we can see that partner B is going to be getting less of the profit share. Because if we're looking at the ratio of 2 to 2 to 1, that's going to be 40% to 40% to 20%. So partner B is going to be getting less profit in the future because of the new partner coming in. And because of that, partner C is effectively contributing some of the goodwill to partner B when partner C arrives. So overall, we can see that the total on the credit side for the goodwill, so that was the goodwill before partner C arrived, was 15,000, and the goodwill on the debit side, the goodwill after partner C has arrived, is still 15,000. So these two cancel each other out, which is what we need to see. And if you have goodwill all on one line, you can see much more easily, yes, we've got the same amount on the left and the same amount on the right. So there we are, that's an example where we have a new partner joining. Let's have a look at another one where we have a partner retiring. So we have A, B and C are in partnership sharing profits in the same ratio as their initial capital contribution. A retires and B and C continue with the same profit share arrangement. Okay, so their profit share is based on their initial capital contribution. So before we have that partner retiring, so if you look at the capital, we've got 10,000, 15,000 and 20,000. So that's a total of 45,000, isn't it? So we can see that partner A, yeah, they're going to be getting 10 out of the 45. So yeah, they've got a profit share ratio of 10 out of 45. And then for partner B, 15 out of 45. And partner C is 20 out of 45. Yeah, so that's their profit share ratio before the partner retires. And then afterwards, well, we're going to be removing the partner A, aren't we? So we're going to have 15,000 to 20,000. So we will have a new profit share ratio of 15 to 20. Remember, it's based on the initial capital contribution. Okay, so the profit share ratio afterwards will be 15 to 20. Right, what else do we know? We know that goodwill is valued at 63,000. So again, when we have our goodwill on our T account, we'll have goodwill on the credit side and we'll have goodwill on the debit side. Both sides will be 63,000. So what we need to do then, first of all, is share the goodwill between the three partners before the retirement. So we share the 63,000 in the ratio of 10 to 15 to 20. So 10 45ths of 63,000, that's going to be 14,000 for partner A. And then 15 45ths of 63,000 will give us 21,000 for partner B. And then 20 45ths of 63,000 will give us 28,000 for partner C. So there's the 63,000 shared between the three partners before the retirement. And then on the debit side, we need to have the same 63,000, but shared in the new ratio of 15 to 20. Okay, they're keeping on with the same ratio arrangement. It's based on the initial capital contribution. In your assessment, they may give you a specific ratio, as we saw just now, the 2 to 2 to 1. But in this case, it's based on the initial capital contribution. So the 63,000 then, in the ratio of 15 to 20, that means we're going to have 15/35 of 63,000. That's going to be 27,000 for partner B. And then 20/35 of 63,000 will give us 36,000 for partner C. Okay, so there's our 63,000 again, but now ignoring partner A. Partner A gets nothing because partner A is leaving. Okay, so there are all the numbers. Let's balance off our accounts now. So we've got a total of 24,000 for partner A, and then 36,000 for partner B, and 48,000 for partner C. And we need to put the same numbers on the debit side. Okay, so this is what you'd be doing on your scrap paper in the assessment. And then we need to have our carried forward balances. So for partner C, we can see we're going to have a carried forward balance of 12,000. And for partner B, we're going to have a carried forward balance of 9,000. And for partner C, there's going to be no carried, or partner A, there could be no carried forward balance because partner A is retiring. So we need to have some number here, though. We've still got some 24,000 that we need to deal with partner A. Well, partner A is leaving, and effectively what's going to happen is that partner is going to take their money out of the business. So the partnership has to pay 24,000 to partner A when partner A retires. Okay, so let's look at the starting and end positions. So partner B had 15,000 of capital at the beginning and now has only 9,000. Partner C started with 20,000 and now has only 12,000. So both of them have lost some money when partner A retires. Well, why is that? Well, it's because partner A put £10,000 into the business when the partnership started. But during that time, the business has been growing. Partner A has been working hard, and now the business is worth more than how much money the three partners initially put into the business. Yeah, they started the business by putting in 45,000 into the business between them. But the business is now worth more than 45,000. The business is worth much more than that. So when partner A leaves, partner A should take out the initial 10,000 that was first paid in, but also take out their share of the goodwill. So partner A is getting £14,000 worth of goodwill. Yeah, that's being given to them on top of the 10,000. And it's partner B and partner C have to pay that money to partner A. Okay, so that's why partner B and C have less capital now, is because they are transferring some of their capital to partner A to take into account that partner A has been working hard in the business and has generated some of that goodwill. Notice again that the total of the debit side for goodwill is the same as the total of the credit side for goodwill. Again, if you keep it all on one line in your T account, it'd be much easier for you to see that they're both the same totals, and therefore everything should be okay.